Welcome back to the Deep Dive. Today we are looking at one of the most confusing market reactions we've seen in a while.
Yeah, we're jumping into the Q3 2025 earnings call for Trupanion. That's ticker TRUP.
The pet insurance provider.
Yeah.
And this was, well, it was a fascinating call.
It really was. This was after hours, November 6th. And management laid out this, this really strong story of fundamental improvement.
Record results, basically.
Exactly. But the market had a completely different take. So our mission today is to figure out why. Why did investors punish such a strong print?
Okay, let's start with the numbers then. Just the headline figures. On the face of it, this looked like a huge win.
No question.
GAAP EPS was $0.13, and the analysts, they were looking for something around 8 cents.
So that's a massive beat. I mean, something like a 63% surprise on earnings per share.
And the top line was solid too. Revenue came in at $366.9 million.
Which also beat consensus by about 1.5%. And it's up 12% from last year. So, solid growth.
But for a business like this, you've said before, we need to look past the GAAP numbers.
You really do. For Trupanion, the metric they want you to focus on, the one they manage the business by, is adjusted operating income, AOI.
And just remind us, what is AOI in simple terms?
Think of it as the pure profit they make just from their main business, selling those pet insurance subscriptions. It strips out all the corporate noise.
Got it. And that number?
That number was $40.9 million for the quarter, up 26% year over year. So by every metric that management cares about, this was a home run.
Okay, so here's the paradox. Great revenue, spectacular EPS beat, huge growth in their core profit metric.
And then
the stock gets hammered. It fell 8.3% the next day.
On heavy volume, too. We're talking double the average number of shares traded.
That's not just profit taking.
No. A volume spike like that, it signals real skepticism. It's the market saying, yeah, we see your numbers, but we don't believe the story. And that's the disconnect we need to unpack.
So let's get into management's side of that story. The CEO, Margi Tooth, she really framed this as a turning point.
She did. She talked about a 24-month journey of, disciplined execution.
2 years of tightening the belt.
Exactly. And now, she says, with record margins and cash flow, they're ready to shift, to go from defense to offense.
That's a huge shift in tone for them.
It's monumental. And you can see why they're confident if you look at the subscription segment. That's the profit engine.
And that's where the AOI really shines.
It hit a record. $39.1 million, up 27% from last year. And that translated into a record 15.5% subscription AOI margin.
150 basis points of margin expansion. How did they do that?
A big piece of it was just getting a handle on vet costs. The amount they paid out in claims dropped to 70.1% of revenue.
Down from 71% last year.
Mm-hmm. It means that price increases are finally catching up to, and maybe even getting ahead of, veterinary inflation.
And it wasn't just pricing, right? They talked about efficiency, too.
Yeah, their other costs, fixed and variable expenses also came down as a percentage of revenue from 15% to 14.5%. So every part of the defensive plan was working. They're making more money per pet than ever.
Which gives them the firepower to go on offense, like she said.
Precisely.
So the defense clearly worked, record margins. But a growth stock is judged on growth. So how did the offense part of the story look? Let's talk about the pets.
Okay, so total pets under subscription grew 5% year over year. It's now at 1.08 million.
Which is good, but the real story is in the new additions.
Yes. The net subscription pet additions. That metric was up an incredible 45% year over year.
Wow.
They added over 16,000 net new pets. That's the strongest number they've posted in almost 2 years, 7 quarters.
Okay, so that confirms the pivot. They're turning investment into actual volume growth.
Mm-hmm. And they're keeping the customers they have. Retention is the bedrock of insurance, and that ticked up slightly too. Trailing 12-month retention is now 98.33%.
That high retention is so important. It lets them spend more to get new customers because each one is worth more over their lifetime.
And that's exactly what they did. They spent more than ever on acquisition.
How much more?
They put $20.4 million to work to bring in about 68,000 new pets. Management was very clear this was their highest spending level ever. The offense is on.
Okay, so the big question the market is asking is, can they keep spending like that without killing those beautiful new margins?
That is the multi-billion-dollar question.
Before we answer that, there's another piece here, a huge win on the balance sheet. The cash flow.
Oh, yeah. The cash flow story is just as strong. Operating cash flow basically doubled to $29.2 million, and free cash flow hit nearly $24 million in the quarter.
So they're generating a ton of cash.
A ton. Their trailing four-quarter free cash flow is now almost $72 million. And they used that strength, ending the quarter with, nearly $350 million in cash.
To do what?
To pull off a really smart debt refinancing.
Let's quantify this, because this is a real tangible win that feels like it got lost in the noise.
It absolutely did. They refinanced their old term loan and got a new 3-year, $120 million credit facility with PNC Bank.
And the key is the interest rate.
The key is the interest rate. Their old debt was priced at the SOFR rate plus 5.15%. The new debt is SOFR plus just 2.75%.
Whoa, that's a 240 basis point drop,
Right.
a 2.4 percentage point saving.
Exactly. And that flows directly to the bottom line. Management expects this to save them between $8 and $9 million a year in interest payments.
$8 to $9 million. That's pure profit they just created out of thin air.
It's a non-dilutive boost to earnings. The market's reaction suggests it completely missed or dismissed this.
So better margins, faster growth, and now cheaper capital. They also talked about expanding their reach.
Yeah, a new partnership with BMO Insurance in Canada.
Why Canada?
It's a huge runway. Pet insurance penetration there is only about 4%. They see it as a long-term play. Plus, they're still scaling up in Europe.
And their guidance for the rest of the year backed all this up.
It did. They raised the low end of their full-year AOI guidance. The midpoint now implies 31% year-over-year growth.
And the really crucial part was the look ahead to 2026.
Yes. They basically telegraphed their next move. They said investment will increase next year, and they want pet volume to be the main driver of revenue, not price hikes.
The pivot to offense confirmed.
Confirmed.
So this brings us back to the central mystery. Record margins, accelerating growth, a $9 million gift from a new debt deal. Why on earth did the stock drop 8.3%?
Well, you have to look at the context. The stock has been under a lot of pressure. It's down about 33% over the last year, while the S&P 500 is up 13%. So investors are already nervous.
Okay, but it's the valuation that's the real sticking point, isn't it?
It's all about the valuation. The market demands perfection from the stock. A typical insurer might trade at, 13 times earnings.
And Trupanion.
Trupanion trades at over 100 times earnings. So the market isn't valuing it like an insurance company. It's valuing it like a high-growth tech platform. And when your multiple is that high, even a tiny hint of future risk gets magnified into a huge problem.
So what's the specific risk being priced in here? What are investors afraid of?
They're afraid those record 15.5% margins aren't sustainable.
Why not?
Because of vet cost inflation and competition. The fear is that one of those two things will eventually force Trupanion to either spend more or raise prices less, and that will cap their earnings power in the long run.
So it's the classic growth versus profitability trade-off.
Exactly. Management just proves they can be profitable. They deliver the margins.
But to get that 45% growth in new pets, they had to spend more than ever before.
And the market is betting that you can't do both at the same time, not forever. That spending more to grow will eventually eat into those margins.
The market thinks they're going to spill the coffee.
That's a perfect way to put it. The market assumes they're going to spill. And that skepticism is why the stock sold off, despite a fantastic quarter.
Okay, now let's switch gears. This is the part of our deep dive where we have to be very clear.
Mm-hmm.
This is for informational and educational purposes only. It is absolutely not financial advice.
Right. We're analyzing the call. We're exploring the dynamics. Do not run out and make a trade based on this. Do your own rigorous homework.
With that very important disclaimer out of the way,
Yeah.
let's talk about a wild but plausible trade idea.
Okay. So the idea is to exploit what looks like a massive overreaction. That 8.3% drop just seems totally disconnected from the fundamentals.
Especially when you factor in that debt deal.
Especially then. The market completely failed to price in the, that $8 to $9 million in permanent annual interest savings.
A permanent boost to the bottom line.
A permanent boost. You combine that with accelerating growth, that 45% jump in net adds, and you have a company whose fundamentals are getting stronger while its stock price is getting weaker.
And analysts see fair value way higher than the current price.
The ones who dig in see it in the mid-$50. The stock is trading around $35, so there's a serious disconnect.
So how would you structure a trade to bet on that gap closing?
Well, the idea would be a long position in Trupanion. But given the volatility, you wouldn't just buy the stock. The move would be to buy long-dated, in-the-money call options.
Buy option.
It gives you leverage. You're betting on the fundamental story, the cash savings, the accelerating growth, forcing the market to re-rate the stock higher over, say, the next 18 to 24 months.
So a leveraged bet that the fundamentals will eventually win out over the market's fear.
That's the trade.
All right, to wrap this all up, we've seen three key things from this deep dive. First, Trupanion proved it can be highly profitable. That 15.5% subscription AOI margin is a record.
Second, the pivot to offense is real. Pet growth is accelerating, and they are spending to make it happen.
And third, that P&C debt deal is a massive and probably underrated win for their capital structure, an immediate $8 to $9 million annual tailwind.
So my final thought for you to chew on is this. Management has drawn a line in the sand. They're going to spend heavily to grow, and they plan to do it while protecting that 15.5% margin.
The tightrope walk.
Tightrope walk.
Yeah.
And whether they can successfully pull that off, grow fast without stumbling on profitability, that is the single most important test for this company and its stock in 2026.
Their execution is everything now. Thanks for joining us for this deep dive into Trupanion's Q3. We hope this analysis helps you make sense of a very complex market signal.